So I want to thank all of you who are joining us today for my quarterly webinar. And today I actually have a very good friend, James Longstreet, who's co-hosting this with me. So he's invited his client base, and he's out of Calgary. And of course, I'm out of Chilliwack. But really who I want to focus on this morning is our guest, Martin Straith. He is the founder, president of Trend Letter. I actually met part of his team at an event in Vancouver with Michael Campbell, the World Outlook Conference. And so I'd heard Martin several times on Howe Street. He's a regular guest on several financial talk shows, as well with Michael Campbell and Howe Street, and I think another one. So let me just give you a quick overview of Martin. And just so you know this is recorded. So if you want to go over it again, you can do that. So just give you a quick synopsis of Martin. So Martin actually came out of the tech world in the I guess late in the 90s, and was very good at analyzing things. And he saw a lot of friends lose money in the dot-com bomb. And he asked them, well, why didn't you sell your stocks when you saw there was bubbles everywhere? But of course, Martin will talk more about this in a minute. But so Martin actually, out of that, decided to start helping people. So he developed a Trend Letter. And in the Trend Letter, it's published weekly every Sunday evening. And it actually covers everything from equities, currencies, precious metals, commodities, and bonds. So it gives you a broad spectrum of the market. So that's kind of his major newsletter, but he actually has two other ones. And actually, Martin has graciously offered to provide a discount for those who actually want to participate in his three different services. So the first is the Trend Letter, and it's really designed for long-term investors who want to better understand the markets. He also has a second letter, which he focuses on tech trading, the trends in technology. And of course, as we know, this is kind of also a hedging strategy, and it helps people during volatile times, just like we're in right now. And it invests long positions and covers sectors like commodities, equities, and precious metals. And his third one is focused on trend disruptors. So Martin and his team actually do a deep dive into what are the big trends happening in the markets, and as far as disruptors. And of course, that would be artificial intelligence, virtual reality, augmented reality, 5G cloud, Internet of Things. So that's a very speculative market. So those are for people who want to be more in high speculation markets. So anyway, with no further ado, we're going to cover today, actually go through 6 questions with Martin. We'll have a bit of engagement with him. But so to start, Martin, what I'd just love you to do is give the audience just your perspective on the broad overview of the markets today.
Okay, thanks, Bill and Jason. Good to be here with you. Yeah, now one of the things I'm going to do, I'm a very visual person. We do a lot of technical stuff, but I really think seeing a chart, seeing an image really helps explain it rather than just listening to me rabble on. So what I'll do is I'll be showing a lot of charts and images here. But first of all, so if we look at today's market, one of the things we need to understand is that markets are the strongest when you have broad participation, and they're the weakest when you have very narrow participation. And right now, the market's been going up, but it's all based on this artificial intelligence frenzy that's been happening. And the stocks that are driving this are just those big tech stocks. So we're talking about, 8 to 10 stocks that are driving this whole market and this whole euphoria that's been happening with artificial intelligence. Without those 8 stocks, we'd be looking at the S&P would actually be negative for the year right now. So this is something to really keep in mind. So if we look at this is a great image. These are called a heat map. And what it does is it's a month heat map of the S&P 500. So this map is showing all the stocks in the S&P 500. And basically the size of each block for each stock represents its market capitalization. And then the color, obviously, the greens are the stocks that are up and the reds are the stocks that are down. Bright green are really up and bright red are really down. So very quickly, like you don't have to be a technical person at all. Very quickly, you can see what's driving the market right now. You've got Microsoft, you got Apple. You've all heard, I'm sure, NVIDIA. I mean, their market capitalization has just skyrocketed. They're up almost to $1 trillion already.
Wow.
So, and you got Google, Meta, Amazon, Tesla. You know, here's a One Health stock. But look at all the red. This is all red through here. There's a few little green ones, but generally, we're looking at that these big stocks, big tech, they are driving this whole market here. So it's very narrow. This is a very narrow, a very weak market rally. So you have to be careful. If you're an investor, be very careful here, because when you see a NVIDIA, I unfortunately, I don't have I should have brought a chart of that, but that stock is just parabolic right now. Yeah. And when you see parabolic moves, you've got to be careful. So we saw NVIDIA back in 2000. It had a massive rally. It lost the whole thing within a year. So be aware. And now I'm not saying that this market rally is over. I'm just saying be careful. No, so the other thing we want to look at, here's market sentiment. And there's a number of indicators that you can look at to see this. This is CNN's fear and greed. And it's a great little indicator. It really does tell you where the general market feeling is. So they use 7 different indicators. But as we can just see very easily, it's at the high greed level. So we're looking at that, you know, we're working our way toward extreme greed. And whenever the market gets too far one way or too far the other, you're going to see the pendulum start to swing. So again, that doesn't mean we won't get into the extreme greed, but we're definitely working our way toward that end of it. And, you know, as Warren Buffett has said, you know, be fearful when others are greedy and be greedy when others are fearful. And that's what we like to do. We're contrarian investors. So when we see this, we go, okay, now we're not calling that this bull market's over, but it's something that we're going to be aware of.
Okay. Now, hey, can you wrap up this segment in about 30 seconds, Martin?
Sure. Really quickly, I'm going to skip over this one then. Okay. So what we're looking for in market identifying trends. So uptrends, we're looking for higher highs. Yeah. So here's Apple. You see that we have a series of higher highs, works its way up. Yeah. We're also looking for higher lows. Okay. So we got a series of those. And here's the thing for everybody, you're not technical, draw a trend line. It's the most easy visual way to see what this market's doing. Now, I can quickly go through gold. Gold back in November was dropping down, and then it broke through. We put in a stop. So we always put a stop ahead of time. We never just buy it down here. We always wait for that trend to be broken. We need to see it break to the upside. Otherwise, that trend could run another year.
Okay. So James, why don't you interject in here now? This is kind of your question, identifying trends.
Sure. Yeah. Well, Martin, first, thanks for that first response. It was very, very insightful. So now, Martin, can you explain in more detail exactly how do you identify market trends?
Well, so when we looked at gold, we looked at gold. So gold was going through, and then it had that nice big rally. So when we look at trends, our main key here is that we want to see very simply, we want to see uptrends, which are higher highs and higher lows. And then we want to see downtrends. We want to see lower highs and lower lows. And if you just draw those trend lines, then you'll know that you've hit that spot. Does that make sense?
Yeah, no, absolutely.
Yep,
I've done a fair amount of technical, learning on it myself, but that's, I think, an excellent.
I mean, we could go on and on. There's all kinds. I mean, in our models we've built that we've got about 15 indicators that it looks at. But just for visual, for the average investor, to me, if you just go back to these kind of plays, that's gold. If we go back here, it was in a downtrend. Our indicators were telling us it's looking like it's going to form a bottom here. We had a support, but we didn't get lower low. We had the same low. So we kept testing support. That was a trigger to us to start watching. But until we see it break through, we're not going to act on it. So that's the key. A lot of times people they'll see this one, they'll see it jump and go, okay, I'm in. Well, that trend's still down. So you've got to be very careful on those.
Excellent.
So again,
and then there was a break, obviously a transition in gold starting in November. We went from downtrend to uptrend. Eh?
Yeah, right there. So that was that same place. So we broke the trend right here, and we wanted to see it actually break this, make a higher high here. And that's what it did about 3 days later. So you went from
early November,
from here, early November.
Yeah.
So it broke this trend. And then a couple of days, wrong way. A couple of days later, then you broke to a new higher high, and that triggered our buy signal. And then you got this really nice run up.
Yes, yeah. Which thankfully both James and I's clients have participated in.
Awesome. Well, that's what you want to be doing. That's what you want to be doing.
Yeah. So did you want to say anything more about that? But that was an excellent, thank you. That was an excellent, just kind of a basic understanding how to identify a trend up, and I thank you for sharing that, because a lot of people just sort of buy on a tip from someone and not actually taking a look at charts. And, I'm a big advocate that, technical analysis should be part of your decision process in buying things.
Yeah, well, and the key here is and I think we'll talk about it a little bit later too. So this uptrend is here. Now it's a pretty steep uptrend. So if gold falls, which it did soon after this, when it broke down, that first trigger, that's your first warning sign. So now if you bought it down here, you may, I would have said, take some money off the table. You got a nice gain here. You don't have to sell it all, but at least sell some of it. And then if it keeps falling down, you need to have, so to me, this would be your next trigger point.
Yeah.
So, there's a low. If it triggered below that low here at 1925, that's a warning. And that would be right about where it break through here. And then you'd be looking at this one. This by 1910, 1915 would be another sell signal, because the next drop is quite a bit further down. So again, depending where you buy in, depending what your position is, you really want to have predefined sell stops, so that when you're going to get out in case you're wrong. And that's a big thing, because we're going to be wrong. As an investor, you'll be wrong. Most investors are wrong a huge percentage of the time. But even if we've got a very good record, but we're still wrong maybe 30% of the time. Yeah. So we need to have a plan that those 30% of your trades have very minimal losses. And then your winners, you want to let them run. Yeah. But that's how if you just draw these lines, that's how you start to see that this is a time for me to be nervous or things are looking really good.
Yeah, no, great point. Well, let's transition, I think, to the next question, Martin. So, in our pre-talk, we and just so the audience knows, this comes out of us saying, what are the most important or the most pertinent things that we should discuss with the audience, things that they should be aware of. So that's where this comes out of. So the next topic is actually, why are you concerned about debt levels? And we can talk US or global, because that's the thing I talk a lot about with clients. Probably one of my greatest concerns is debt. So anyway, go ahead, Martin.
Well, yeah, and so is mine. And the thing here is, unfortunately, nobody in government has that same fear. We all know right now that the US debt ceiling, all that discussion and all the big dramas going on. Yeah. But we also know that I think it's over the last 63 years, they've raised that debt ceiling over 75 times. So I don't think there's any worry that they're not going to raise it. The worry is that they will raise it, and they just keep raising it. So here's some charts.
Okay.
So again, we had that. So here's Canada. This is from the Taxpayers Federation. So here's the Canadian debt currently. It's a great little clock. The dollars are just flying by. But we have a federal debt of $1.2 trillion.
Yes.
So as a taxpayer, all of your people listening in here, your share of that debt is $35,245.
Right.
That debt is growing at almost $145 million per day.
Wow.
And per hour, we're looking at $6 million per hour.
That's scary. Yeah.
That's horrifying. But you want to see something really horrifying. Let's look at the US.
Yeah.
Okay, so the US has not quite 10 times our population. Yeah. Our debt is 1.2 trillion. Theirs is almost 32 trillion. So this is just totally unsustainable.
Yeah.
Per citizen, so this is per man, woman, and child, almost $95,000 is their share.
Yeah.
Unfortunately, if you're a taxpayer in the US, your share is $248,000.
Wow.
But that's not the big picture. The big picture to me, the big scare to me is their unfunded liabilities.
Yeah.
So we're talking Medicare, Social Security, those kind of things. Well, the US has $178.8 trillion of unfunded liabilities. I mean, these numbers are just mind-boggling, and nobody seems to talk about them. Nobody seems to care about them. But that liability works out to $560,000 per citizen.
Wow.
Now, again, if you're a taxpayer, your share of that unfunded liabilities is $1.4 million. And if you add in that $248,000 for the debt, each taxpayer in the US is on the hook for $1.7 million.
Wow.
So this is clearly totally unsustainable.
Yeah.
So it's going to blow up at some point. And are they fixing it? Now, because here's the next piece, and it keeps growing. Here's the US deficit currently, right now, $1.4 trillion.
Yeah.
So that number is just going up by another $1.5 trillion.
Yeah, it's insanity. And then if you add, and I always, when I do my talks on debt, I always say, and then if you add in derivatives, sort of the shadow.
Yeah, it just gets uglier and uglier. So now here's the cost of servicing that debt.
Wow.
So in the US, they just spent $213 billion in the last quarter of 2022 just on interest on their debt.
Wow.
So that works out to $852 billion a year just to service your debt. So that means that's 850, closing in on $1 trillion a year that isn't going out to help people that, the low income or the middle income. You're actually just paying interest. It's like somebody that's gone crazy on a credit card debt and they're just paying these outrageous amounts just to stay afloat. Now, the US Congressional Budget Office, so this is an agency of the federal government. They put a forecast out about 10 months ago. So it's old and it's even way behind now. But they projected $20 trillion more debt in the next 10 years. Yeah. So not 32 trillion, they're talking 52 to 55 trillion. So this is getting crazy. So what does it mean? Well, we'll skip over that. That's the G20 group. I mean, they all have massive debts. But here's the problem. I see we're going to have a sovereign debt crisis. And I don't think it's going to start in the US because they're the biggest market in the world. But every country's in the same boat here.
Yes.
And a debt crisis is when investors lose confidence in government and they're no longer going to buy bonds. Yeah. And the difference between a public debt, which is government bonds, and corporate or private debt is that when a company defaults, the bondholders, they sell the assets and the bondholders get a portion of their money back.
Yeah.
But a government has no assets. They have no assets. They just have debt. So if they default, the bondholders get nothing.
Yes.
So what you end up with is this panic. And what happens is you get contagion kicks in. Yeah. So we see that once one government defaults, then panic really starts to happen because people then look around and go, well, what if they're defaulting? What about us? Remember back in 2012, Greece was so close to defaulting. Yeah. Then Portugal bonds started crashing. Yes. Then Italy bonds started because people aren't stupid. They catch on. And it turns into like a run on the bank. And so
I was just going to point out, and this is history repeating. The same thing happened in the 80s, the late 80s with the Asian contagion. Then it spread to Russia and you had default after default, right? And then it went into South America. So it was a global crisis.
Well, and wars are another big reason for this that's happened. So after the Second World War, almost every European country defaulted on their bonds. Yeah. So what we've been saying for your listeners, for the last couple of years, we've been warning our subscribers, get out of any long-term government bonds.
Yes.
Short-term's fine, 3 months, 1 year, 6 months, 2 years even, but don't get in these 10, 20 year because, back to up here, if they default, you'll get nothing.
Well, and I think it's important to point out, like a lot of Canadians are in passively managed money, and so these portfolio managers, because by law or by their own model, they have to have certain ports of bonds in there. And most Canadians have no clue that they could have, 20% of long-term bonds in their portfolio, not even knowing that they could default, right? So it's really important to understand who's managing your money on top of it, as well as what is in the portfolio, because most Canadians just don't have the sophistication to understand that.
Yeah, and in Europe it's even worse, where they're forced to buy a lot of government bonds there, and I think Europe's going to be that. I think this first default will be, it might be a small country like Greece or something, but you look at Japan at their massive debt and their aging population, and in Europe, I think that's where it's going to start.
Yeah. That is such a critical point, and again, I try to emphasize this with clients all the time, that first, on a personal level, get rid of debt as quickly as possible. We know now that there's going to be a lot of crisis in the housing market, because as people refinance at higher levels, it's going to put them in trouble. But anyway, the point is, debt is something, as investors, if you are concerned about your wealth and your portfolio or whatever you're working on, you better be cognizant of debt levels, because that's when the big events in history happen, it's always related to excessive debt. Well, so let's transition. James, do you want to take over here?
Sure, and I'll just add a comment that appreciate you sharing all that, Martin. The current system is it's just math. It's mathematically designed to fail at some point. We either their options are to inflate or die, right? So that's anyone that looks at the debt numbers over the last it's just been like a hockey stick, especially since the last 3 years with all the currency that governments globally have printed. So yeah, thanks for sharing that, Martin. Next, let's talk about inflation, Martin, and how all this inflation was created. Do you believe that, as some of the media would lead us to believe, that Putin is the primary villain and the cause of all this inflation, or do you believe it's from other causes?
Yeah, that is the big misconception with inflation. Again, we'll show some charts, and I think it'll be very clear where the problem lies. So inflation in Canada and the US and most of the globe started to rise after COVID. So in 2020, we started to see things happen. And Canada's inflation ultimately hit a high of 8.1% in June 2022. US hit 9.1 at the same time. So here's a picture of the US inflation. You can see very clearly, it started, and this is where COVID happened, right here. So when we look at it, well, let's see why it happened.
Yeah.
So we have monetary policy. So from 2009 to 2020, the US Fed, so that's monetary policy of central banks. So they had a balance sheet of $902 billion. So over the next 12, 13 years, they added another $2.87 trillion. So they went from $902 billion to $3.77 trillion. And their whole purpose here, as I'm sure everybody will remember, back then inflation was a problem the other way. They couldn't get it to 2%. So they kept printing money. They kept buying mortgage-backed securities because they wanted to keep interest rates artificially low so that so companies and businesses and tech stocks and so on could borrow money cheaply and reinvest. And so it worked to some degree. The stock market took off. The housing markets took off. But the average person in the street didn't do very well at all. But so what happened is that just never worked. They kept doing it, kept trying it. And then COVID happened. And what did they do? Well, they locked down the economy.
Yeah.
And so when you lock down the economy, then you shut down the supply chain. So what they did is they closed businesses, nobody could go to work, all that kind of stuff happened. And then the supply chains. We can remember seeing the ships were in, LA Harbor, here in Vancouver. You could see ships as far as you could see. They couldn't unload. They couldn't load and ship their goods out. China was massive. The Shanghai harbor, there's some massive images of how many ships were sitting there. So what you had is you had this massive lockdown. So to stave off what they call an economic crisis, the Fed pledged unlimited asset purchases. And we can see they kept to their word. So from that point, From 3.77 trillion, they bumped it up to 7.17 in a matter of 6 months. They added $3.4 trillion to their balance sheet in 6 months. So, and then by April, they had it up to 8.97 trillion. So they had added 5.2 trillion in just over 2 years. So then fiscally, same thing. When those lockdowns happened, governments started massively sending out money. Yes. They called them relief packages. They had all kinds of fancy names for them. But basically, the US alone, they issued over $5 trillion in relief packages. And this is the chart of the US personal savings. You can see that, you know, it was always hanging under 10%. Just before COVID, it was 8.3%. Within 6 months, it went up to 33.8%. I mean, $5 trillion goes. So they got the first payment, then they spent it, dropped back down. They got the second payment, spent it, dropped back down, and then went all the way back down. So each relief check jumped it up. So now we look at how this all kicked in. So between the fiscal and monetary, the US pumped in over $10 trillion. And that's just the US. Canada, you know, we handed out hundreds of billions all through Europe. They did the same thing. So now we have supply chains are still shut down. They're slowly trying to recover. But now all of these people have all this money and they're looking to spend it. So what you've got is you've got all this money out there chasing fewer goods. And that's how inflation happens. Yeah. And so you went, the first stimulus check here, look at inflation was at almost zero. Right as COVID hit, inflation dropped to almost zero. Yeah. Then first check, it pumps up to about 1.5%. Second check gives it a big boost up to about 5.8%. And then the third check bumped it up to over 8%. And back to James, your comment, did Russian invasion cause inflation? That didn't happen till here. It was already almost peaking by the time Russia invaded China. Now, that certainly didn't help. It bumped it up more. But this is the whole cause. Yeah. And this is just the US, but Canada is very similar. I mean, our central bank did the same. Our federal government did the same. And this happened all through Europe, everywhere. Then the Fed started to raise rates. Inflation starts to come back down.
So James, or maybe we should start transitioning. Maybe you got just a couple more comments on this, and then we'll transition to the next question, Martin.
Sure.
No, I'll just jump in and just say one thing, Martin. And yeah, these numbers that you're using are these official government statistics, and as many people be aware of, you know, for example, John Williams of ShadowStats.com calculates inflation the way it was you know, it was done in 1980, and I believe, if I recall, when the official U.S. number was 9.1, John Williams' number was around 15 or 16%. Right.
Absolutely. You know, and they play with those stats as well, you know, all over the place. But like you say, I mean, this is from the Bureau of Labor Statistics. But even with their numbers, it's outrageous, right? And when you look at the debt, same thing. If you look at their debt totals, those are all triggered. You know, they have a you know, a debt number, and then they backdate things. You know, they tweak the numbers, but no, it's never in the news anymore. So, but yeah, it just tells you though. And again, I'm not, you know, politically saying, oh, you shouldn't have done some of these things. I mean, people are hurting. They're reacting. They're running around with the chickens with their head cut off. They didn't know what was going on. Certainly the Fed overreacted by keeping the rates way too long. Yeah. And then, you know, telling us it's transitory. You know, the Federal Reserve has over 400 PhDs in economics, and they seem to get it wrong every time, which is just mind-numbing.
Yeah, it's true. Hey, let's transition now. Thank you, Martin. Thank you, James, for commenting. Let's go to the next, which is really important because this has been in the news for over a year. So do you think, Martin, there's going to be a recession? And if there's going to be a recession, how is it going to impact the average ordinary Canadian or investor or American, doesn't matter, or European? How will it affect in a potential severe recession?
Yeah, and it is. It's a topic that you know, if you watch CNN and BNN, it's like every day it's soft landing, hard landing, no landing. But here's the thing. I mean, I just look at, you know, history and reality. So there are two incredibly accurate leading indicators. So these are not lagging indicators. We're talking leading.
Yeah.
So that have an incredibly accurate history of calling a recession and for not a recession. So the first one is the yield curve.
Yeah.
And I'm sure all your people have heard of the inverted yield curve, but maybe they don't really understand it. So a yield curve gets inverted when the short-term yields are higher than the longer-term yields.
Yes.
And then that doesn't make sense, right? If you're going to lend the government money for 10 years, you expect that get a higher yield than if you only lent it for 1 year. I mean, your risk is much higher to give it for 10 years. But in the when you're coming up to where the short-term yields are much higher, it's telling you that the investors are saying, I'm willing to buy this long-term yield because I want to lock in what I consider to be a higher yield that when it's going to be, because I think the economy's in trouble and it's going to start sliding. And if that way, at least I'm locked into this and I get a bit of higher yield because I think those rates down the road are going to change. So what we have is in history, so since 1955, so we're talking 68 years, there's been only one time when the yield curve was inverted without there being a recession.
Yeah.
So that's like a 98% accuracy rate. So I tend to believe that rather than listening to people talk. This isn't my opinion. This is just fact. Yeah. And recently, the yield curve's been the most inverted it's been for over 40 years. So here it is today. And you can see that black line shows where it starts to be inverted. So you can see here, just a month or so ago, it was down here. Well, it hasn't been that low since, the early 80s.
Yeah.
These gray bars are recessions. Every single time, it's a recession.
Yeah.
So to me, you can argue that maybe it isn't going to happen this time, and maybe it's, that 1 percentile chance. But typically, when the yield curve inverts, it's 6 to 18 months prior to a recession. So we had a brief inversion here, but it only lasted a little bit, and that was back in April. But we've been fully inverted since June 2022.
Yeah.
So we're now coming up to 1 year. We're up to a year now that we've been inverted. Well, if this is real, which it is, 6 to 18 months, we're right in the middle of that right now.
Yeah.
So the odds of a recession is going to happen, the odds are it's going to happen this year.
And and I think this is really important to point out. Like, it's actually in a positive way, like there is a positive out of the negative, where people have actually been able to get on short term. Like I can get 4.5, 4.2, 4.75, depending on the money, on short term 1 year. You can't get that on a 5 or 10 year. It's ridiculous, but that's so so we finally now investors can actually get some return, some yield on their money with low risk. So but that I think it's really important to point out, even though this is true, pointing to possibly a severe recession, there's still opportunity for investors if they know what to do.
Well, and like you say, it's an alternative where before, for the last 12 years, you had to go to the stock market pretty much, basically for the average investor, because you couldn't get any yield on your money.
Yeah, exactly.
Okay. So there's another one. So if we go to, there's another one, which the Conference Board leading economic indicator, again, historically, almost 100% accuracy. Just real briefly, if you ever drop below this red, that's a recession. So you can see here, red recession, red recession, red recession. Hey, we're red. So you don't have to be a rocket science to at least be cautious here to say the odds of a recession are very high. Yes. Now, the governments will try and kick in and save the day, but beware that a recession is likely to happen. So then you go, okay, what does that mean to people?
Yeah.
Well, it's not good. When a recession happens, people spend less, people lose their jobs, unemployment rises, businesses are no longer selling as much product, small businesses get hit really hard, so they have to lay off people. So now everybody's getting nervous, and we're starting to go, well, I'm a small business person, I can't afford to keep this staff, so I have to lay them off, and that hurts, that creates stress for those people. One of the spouses may have lost their job, the other one's worrying. So then you just get this whole personal stress. Real estate tends to decline. that reduces your equity ability. That makes it difficult to get credit. So here, all of these things combined just create a big, nasty ball of stress, really. Yeah. So then you get into investments. So one of the keys people need to understand is stock markets do not do well in recessions. Yes. So here we're going back to 1982. Every one of these gray bars is a recession. So if we look at it, if we go back to 80, it was late 81, we had tight monetary policy because they're trying to fight inflation. Does that sound familiar?
Yes.
It does kind of sound familiar, right? Well, look what the stock market, look what happened to the stock market. It crashed. Then we go into the early 90s. We had the Gulf War, and then we had the savings and loan collapse. Yeah. What happened to the stock market? Down. Then we had the dot-com bubble. Now, I don't know, most of your listeners, I'm sure, certainly remember that one. Yeah. Massive crash in the stock market.
50%.
I mean, the NASDAQ lost 75% of its value.
Yeah.
I mean, these aren't simple little moves here. These can be very dangerous. Then 2008, financial crisis. Look at that. I mean, huge losses. Yeah. COVID lockdowns. I mean, it was very brief. But look at, I mean, that's very familiar. It happened just recently. So when we look at that, you know, we need to know when sell-offs can be significant, panic kicks in, and that becomes a force. And so on the positive side, let's, you know, we got to have a glass half full here. Look at when the bottom is in on these. Massive upside.
Booms. Yeah. Boom.
Boom. Yeah. Boom. So for us, if we have a recession, you know, hopefully it's steep and it's quick, and then the market can kick in, and that's where we, you know, James, you're talking the trends and all that. That's where our models really kick in, and they'll recognize when we hit the bottom and that bottom starts to turn, because it's really hard when it's going down so steeply. People are just scared, and the reason it gets so out of whack is because people just, when these things happen right here, people say, "I'm never going to buy a stock again."
Yeah.
It happens every one of these. You know, I started the trend letter here when my friends said exactly that. I've lost everything. I'm not buying stocks anymore. And I said, no, this is a time you start thinking about buying stocks. Yes. Because, you know, all the sellers have sold. So now.
So Martin, that is awesome, wise counsel. And this is some of the benefit if those who are interested in signing up for his subscription of Trend Letter. He'll actually give you guidance on when to sell, when to get back in the market. And this is the big problem. As you said earlier, everyone buys stocks thinking they go up forever. They only ever think of it's going to go up forever. Well, that's not true of any asset class. There's always correction or potential crash. So, hey, so just for the audience to know, Martin has been gracious enough to also provide a discount on his newsletters, that the 3 different ones. But also, if you have a question for Martin in about 7 minutes, we're going to spend about 10 to 15 minutes. If you have a question, please put it in the Q&A. Just write in your question, and then James and I will ask each question. So we want to make sure you guys have an opportunity to ask your question. So James, why don't you take over? And really, this is really important, the last question. So I'll let you
sure
that, James.
Sure. Thanks, Bill. And so considering everything we've discussed today, Martin, appreciate everything you've shared with us, and considering the current market conditions, for the average investor, in your opinion, what should they consider doing, and how should they consider positioning themselves?
Well, so when we look at the market, so this is the S&P 500.
Yeah.
So we've got an uptrend line here, so that's good sign. So the trend is up. This one's just from October, and that takes us up into, like, say, the 4,000 level. And the reason I use the S&P 500 is it's a big market. It's kind of a middle ground one. It's semi-retail. It has most of the stocks most people buy, so it's a good kind of indicator. But again, remember that heat chart that we showed at the very beginning. That even though the S&P 500 is up, it's all because of those 8 stocks.
Yes.
So that's very important to remember, because if we get a correction in those 8 stocks, watch out. But right now, so what I'm watching is, okay, that trend line's up. And even shorter term, we've got even a steeper trend line. So what we'll be watching for is we got the 4,200. And you can see that the 4,200 level is just broke above this previous one. So that's a good sign. So higher high, right? We've got the higher high. So that's good. So if we can keep going up, that's excellent. So there you go. So that's our resistance right now. So it's right at that. It's testing it. It hasn't been able to get, I mean, it's 4204. So it's just nudged over it on Friday. So that's what we want to keep an eye on. So then we look at, well, what's the floor? What's the support level? Well, you can see here, we tested support, but we didn't break it. We tested again, it held. That's a good sign. That's a stronger support. So right now we're trading between this range. And you want to think of these, I always like to refer to these as like, consider this like a house. So there's the main floor and there's the ceiling. If we break through here, basically we're going upstairs. We're going up to the second floor. Right. And if that happens, then we have a new ceiling. So now the 4,300 kicks in. So now if we kicked in up here, this 4,200 becomes the support level. So that becomes now your floor. There's your ceiling. Now, if we drop and go down below here, basically we're now going down to the basement. And that's, to me, the way I like to look at it. So that if you go down, then this would become a new resistance level, and then we'd have to kick in on a new support level.
Yeah. So
if we look at gold, which is pretty popular, and I think everybody should certainly own some gold, or at least, I would say it's kind of like fire insurance. You want to own it. Yeah. You maybe not, you don't want to have to own it or have to use it, but it's there. Now, gold has had, we looked earlier briefly of that nice, it broke the trend line and it rode up, and then it broke down again, rose up. I mean, gold can be fairly volatile, but right now we're seeing gold, it's in a downtrend. It's, a series of lower highs and lower lows. So we need to keep an eye on that. We like gold. It is actually, when it started up here, this level here was where our models were looking for a floor to hit here. So we're looking for this to form a floor here, but it may not. We have we can't guarantee that.
Right.
So now what it did though, it broke through this level. You see that support, then it broke through this level. So far right now, gold's not looking great, but it is getting oversold. So we're keeping a close eye on this.
Okay.
Now you want to see that we're testing that's uptrend line. So you've got it broke that support, and now it's right at this trend line. If it breaks down there, that's not good news. Right. So what we're looking at here, if this level does not hold, we could see a test here at the 1900 level. And if that doesn't hold, look at this gap here. We could drop all the way down to 1825. Okay. So that's just something people need to be aware of. But if you're holding it long term, it shouldn't be that big a concern. Yeah. But if you're speculating and you've got a lot of money here, because unfortunately gold bugs buy a ton of gold. They don't ever believe it'll go down, and then they don't, and they put such a huge amount of their portfolio into it. So if you're overextended gold, look to, if it breaks down here, you should probably lighten up. You should have lightened up here, but you gotta have a plan. So the other thing then, oil, really quickly, downtrend. It's been trading down, but then it broke out of that, and it's just been basically the last little while. It's just been trading sideways in about a $20 gap here. Yeah. So long term, though, we're very bullish oil. We bought this right. This hit our target right on the button. We also are expecting that we will probably hit this target again. Yeah. So it might present another good buying opportunity. Things to remember, though, if we do have a recession, that's going to hit demand. That's going to drop gold prices. Long term, though, we're very bullish demand-wise. China, India, I mean, that's 2.5 billion people. Yeah. India is growing like crazy. Now, on the supply side, you've got a lack of investment. We got capital expenditures in this sector are at 35-year lows. You've got government, and the reason is government taxes, windfall taxes, increased regulations, no new permitting. So that combination, you can have increase in demand and you have had no investment in this sector. So you're going to have a serious supply problem for years. I think you're going to see $150, $200 oil.
Wow. That'll be hard to fill up the gas tank.
It will be. Okay, really quickly, for investors, your biggest obstacle is your emotion.
Yeah.
You know, fear and greed. We looked at the fear and greed thing.
Yeah.
You know, that's great when greed's all good, everything's going, my portfolio is up. But when it goes to the other end of the pendulum, when you're in extreme fear, that's dangerous. So what we tell people, what's your risk tolerance? I call it the sleep factor.
Yeah.
You know, are you having trouble sleeping at night worrying about your investments? If you are too invested.
Yeah.
It's particularly that sector. If it's gold and you are massively invested, you know, you've got to reduce your risk.
Yeah.
Now, how do you reduce it? You need to have an exit strategy. And as you mentioned earlier, we have our technical trading service, which was originally a hedging service, and it's done fabulous for all investors during these really volatile times.
Yeah.
You know, it's like buying fire insurance for your house. You hope you don't need it, but you're sure glad you did when you bought it. So before you trade, decide how much money you're willing to lose on that trade. Yeah. And have a sell stop. And, you know, we use technical support to determine our sell stops. You know, we tell our subscribers every time we do a trade, we tell them what we're buying. Here's our buy signal. Here's our sell signal.
Yeah.
They can use ours or use their own, but you've got to have one. And when the logic, you know, I mean, when you buy a stock, you know, as you mentioned earlier, people hear it's a great stock, it's a great sector. That all the logic may have been great, but maybe you were too early. You know, maybe the company had some unforeseen happen, a strike, embezzlement, you know, some regulatory issue. You don't know. We don't know. And so if your trade drops below your planned sell stop, sell it.
Yeah.
And that's the hardest thing for people to do, is to sell at a loss. They buy it at $10. It goes up to 11. They're feeling great. It goes back to 10. Then it goes down to 9. Then it goes down to 8. And they still haven't had a plan to sell it.
I've been there, done that, Martin.
We all have. Everybody has.
Yeah.
I mean, and you talk yourself out of it. This time's different. And what happens is when it drops to that, $10 stock drops to 8, what people will say is, well, geez, I guess I'm wrong. When it gets back to 10, I'll sell it.
Right.
And then it goes down to 7, then to 6, and then to 5.
Yeah, yeah. Hey, we really appreciate your wisdom. Martin's got well over 40 years of trading experience. So we kind of need to wrap this up, but I did promise I want any of the guests to ask Martin questions. So if you could write your questions, and we will actually be happy to ask them to Martin. And then, so I'm just going to open the question box. So go ahead and write your questions, and we'll take another 10, maybe 12 minutes. And then, because I promise we'll be out of here before 1 hour. So I try to honor your guys' time, as well as Martin and myself and James. So any questions for Martin? So Martin, you've done a fantastic job kind of helping people. And I say to clients all the time, I said, you know, if you're asking how much am I going to make in this investment, I said, that's the wrong question. The right question is, what are the risks if I do this investment? And to your point, make sure you have, and this is a good reminder to myself. I'm currently hedging my portfolio as well with different strategies, because, you know, things can happen very rapidly, especially in the world we live in today. Things are changing very quickly. So do we have any questions? Please feel free to ask any questions of Martin. If we don't have any questions, that's awesome. Then you've answered all their questions already, Martin. So, James.
Well, you know, if that's answered most people's questions, that's awesome, because if people understand those key points that you guys have brought up or asked about, I think that, you know, people's chance of being successful just increase dramatically if you have, you know, defensive strategies ready to go. Like I say, our hedging service, it has, you know, it uses different leveraged and ETFs, inversely ETFs, and some of them are leveraged, some are not. So, you know, you can just go neutral. Like if you really believe that the S&P 500 is going to continue going higher, but you want to have some insurance in case we have a recession, you can simply buy an inverse ETF
Yeah.
when it breaks down below one of these trend lines we've been talking about,
Yeah.
and that would just make you neutral for that period of time.
Yeah.
And that's, for some people, that's very comfortable, because now they're not totally out of the market, but they put some insurance on that to cover this, what they, it might be a 6-month recession. It might be a year-long recession.
Yeah.
So there's lots of strategies to use, but you need to be aware of them and then pick the one that fits best for you.
Yeah. And I think it's important to point out the average recession often lasts 18 months. It's not just like a month or two. It can go on for 18 months or longer. I mean, it can go on. If it becomes very severe, like the Great Depression, it actually went on for a decade. So, I mean, hope that's not the case.
Yeah. Well, and officially, recessions are always declared after you're well into them.
Yes, yes.
So I think that the average person knows when you're in a recession before the government tells you you're in a recession. Yeah. If you start losing jobs and your business starts declining, something's wrong here. And they can tell you you're not in a recession, but you know what's going on. Same as inflation.
It's the same as inflation. Yeah. I ask questions like, how much do you think real inflation is? Well, it's clearly not what the government's saying, because you just go shopping or go fill up your gas tank. It's 20% higher than last year in gas, and most food is 20, 30, 40% higher than a year ago.
Have you bought cheese lately?
Oh, yeah.
I just bought some cheese that was like $12 last time I remember buying it. It's $20 right now.
Yeah. Well, I go to, I'll promote Costco for a sec, but for years I've bought honey, those 2 kilo. It was $13.99 for the longest time. Now it's $21.99 for the same 2 kilos. And good for honey growers. One of my clients is a major honey grower. But anyway, but the point is, it's important to know, you need to take action for yourself. Don't trust the governments. Don't trust central banks. You need wise counsel. And, you've really provided that for us this morning, Martin. And James, did you have any final comments? Because it doesn't seem like anyone has any questions. I mean,
I just wanted to say, well, thank you, Martin. And I think, as Bill, we've both talked about for years, the more the average person, the average investor takes time to educate themselves, the more confidence they'll have in understanding why they're making the decisions, and it'll just help them with their planning. And of course, Martin, I really like that you emphasize the fact here that you've got to have a plan and stick with your plan.
Yes.
And that's something that many don't consider as well.
And that's the key of what we're doing. We issue the trend alert goes out every week, and it's like 60, 70 pages, but it's all charts with a few bullets. And the whole purpose there is to let people know what is going on and what's likely to happen, so that they can be prepared to do something. And I know a lot of our subscribers, they'll take the trend letter to when they meet with their financial advisor, and then they plan their course out. And I encourage people to do that. If you're not comfortable doing it on your own, talk to somebody like Bill and James, and find your solution. And we can possibly help out with some of the information that helps them out there.
That is awesome. So any final closing thoughts, Martin, and then we'll actually end because we'll be 1 hour and 6 minutes. So if you have any just final closing thoughts other than that, and as I promised, this is recorded for those who want to listen again. If you didn't take notes or wanted to just listen a second time, I'll have that posted on my website. James and Martin is going to send it out to his subscription. Oh, Martin, you were going to put on a discount slide, I think, on your subscriptions, weren't you?
Yeah. Okay. Hang on. I think it might be in here. Yeah, there. So if they got any questions, just send us a note at info and it's all one word, thetrendletter.com. And again, we have some special offers. Just go to thetrendletter.com/special-offer. And basically you'll get between 40 and 65%, depending. So we have those 3 products, and we a lot of people like to buy a combination.
Yeah.
The trend letter and the technical trader are a very popular combination. And then you get better deals. If you buy all 3, you get an incredible deal. So Yeah, so that's what we do. Our goal here, I'm 68, going on 69. My goal here is to help people. You know, I've made my mistakes. I've learned a lot. You make mistakes. That's how you learn. And so if we can pass that kind of information on, watch out for these kind of mistakes. That's really what we're trying to warn here. So right now, last comment. Like I say, the stock market, if you look, you know, watch those trend levels, watch those, you know, the ceiling. If it can't get through that ceiling, the odds are it's probably going to try and get through the floor. So really be aware of those things. And trends, you know, the trend's your friend if you understand it.
Yeah, that's great. And so this is an annual subscription, not a monthly, just so people.
Yeah, absolutely. No, we try and keep the prices really reasonable. I know lots of other services they charge 3-4 times as much, but you know, our goal when we go to conference like at Michael Campbell's conference, it's just awesome to talk to the people. And, you know, and when people come up and say, you know, that really helped us out, that's all I'm looking for, really.
That's awesome. Yeah. So Martin's got a great team that he's put this all together. I met some of his team players at the conference. I was at the World Outlook as well. But so once again, Martin, I really, really want to thank you for taking your valuable time on a Saturday morning and to help general investors kind of understand, you know, kind of what potentially we're heading for, and more importantly, what to do. Because it's and if you need Martin's help, I would recommend you subscribe to one of his letters or one or two, whatever you feel would best fit you. So thank you.
And you know, and simply just send us a note if you're not, you know, if you need to know more about what these services do. Certainly, we can give you some more information.
Yeah. So there's his email as well. So again, thank you so much. Thank you, James, for co-hosting. And I think we're going to wrap this up because we're just before 11 o'clock. And thank you for all the participants attending as well. Thank you so much. Thanks, Martin. Have a great rest of the Saturday, and James, you too.
Yeah, thanks, Martin. Thanks, Bill.
Okay. Take care, guys.
Thank you.
See you.
Bye.
Bye.